Valueworks holds some names that are atypical for value investors, such as Rivian. And the firm has also held Fannie Freddie preferred since 2009. So a lot going on in this market that impacts you right now.
A lot going on in this market that impacts us right now. It's been a really dynamic moment.
So Tesla, let's talk about that first. Given the fallout between Elon Musk and President Trump, what do you do around this? Would you consider shorting Tesla? Would you actually buy the dip that you saw yesterday? Do you go to any of its rivals? How do you play that?
We think electrification is real. We think there are great ways to play electrification. We think electric cars are the future. We don't think Tesla's a great stock as a surrogate for a cult of personality. Look, it's priced at $1 trillion because people believe that Elon Musk's stock should be priced that way. You could try to make believe you're giving it valuations that justify that, but they're a lie. But if you try to short a cult of personality, you have a risk of going bust. So from my perspective, it's more a point of interest, and if you want to be a gambler, gamble on Tesla one way or the other. If you want to invest in electrification, there are much better choices.
So Rivian is a stock that you own, and I guess they could take market share from Tesla, although the big seller for Tesla is the cheapest car, right? The Model Y, which is like you can get for $35,000. Rivian is like $80,000 to get in. So are they going to change that?
Well, Rivian, I think, was smart in that the first car they brought to market was a super high-end vehicle, and I think it's the best vehicle that you could drive. And I drive it. I'm a hedge fund manager from New York. I could probably drive whatever I like.
R1S or R1T?
The SUV thing, I
R1S,
guess, right?
Yes.
Okay. That said, their next rollout is something that's going to be in the $50,000 price point, which I think is the sweet spot for cars. And that's going to be a mass market car, looking at 200, 300,000 cars a year over the next 2 years from now. The big one that I drive, they're doing 50,000 cars. They might get to 70,000 of those, but that's still a good business. And the long-term trajectory is really, really powerful.
What about General Motors? I mean, yes, they make the lion's share of their money. They make all their money on the big trucks, gas-guzzling trucks, but they have a pretty impressive electric vehicle lineup. They're coming out with a new Bolt, and the old Bolt was already a strong seller. They have the GMC Hummer, the Sierra and Silverado EVs. I just drove the Blazer EV, which was an absolute sleeper.
So the EVs are coming, and the more that we understand that range isn't an issue and you could charge them, the more they're on their way. They're a more powerful option than an internal combustion engine, I'm pretty sure. So the question is, is a standalone EV maker better positioned than one that has to defend their internal combustion engine business? And that's a big investment for the other automakers, and it sort of puts them needing to defend something that's gonna die. So I think you're better served with the standalone, and I think that Rivian will be only one of 2 standalones, because the other independent EV makers don't have the scale that Rivian has. And if you're not sure they're going to be around, and one of them just went bust, another one is likely to go bust soon, it's really hard to commit to spending 50, 100 grand on a car if the manufacturer goes bust and if a light goes on and you can't drive your car
A lot
anymore.
of risk in this transformation. We only have about a minute left here. I do want to quickly get your thoughts here on something I realize you've owned for a long time, Fannie Freddie. You've been in the preferreds. How do you think that the preferreds versus commons will do if the government succeeds in privatizing it?
Well, look, the nice thing
in bringing
it in publicizing, bringing it public,
other way around.
Deprivatizing.
Yes, deprivatizing.
Right.
Thank you.
The nice thing about the preferreds is you can have a target price for them. You can have an estimate of where they'll trade if this comes to pass. Because they're preferred stocks, they're legally entitled to a dividend rate. And so they're likely to trade based on yield, which, depending upon which one you're talking about, they'll be basically 2.5 times today's price if they're paying the dividends and the company has equity value below you. The challenge with the equity is that the government can take whatever percentage of the equity they want for themselves. So when you buy the stock in the open market today, you're maybe getting 20% of the shares outstanding because the government has warrants to buy another 80%. But the government also has a preferred stock that they could easily convert into another 80% of the common or 200% of what's outstanding on it.